So good afternoon, and thank you for organizers for accepting our paper and giving us an opportunity to discuss our research work. So the paper that I'm going to discuss is titled Liquidity in the Large, Evidence from an Exogenous Supply Shock. So this is a joint work with Prasanna Tantri from Center of Analytical Finance at ISB and Professor Ramabhadran Thirumalai. So first, let me start with the motivation part. So prior literature, like Kayam and Madhavan 1996 paper that has looked into transitory price effect, which primarily happens because of order book depth. And there are also some other studies which have looked at price effects which occurs due to permanent shift in the supply curve. So like studies done by Scholes in 1972. But Scholes has found that this shift in supply curve is because of some endogenous reason, because sellers has always more information. So these studies suffers from confounding effects and endogeneity issues. So in this paper, we try to address this endogeneity issue. We have some exogenous supply in Indian market where promoters were asked to reduce their shareholdings due to some regulation. And moreover, classical finance theory assumes that every asset A in the market has a perfect substitute B, which has the same risk and return characteristics. Even in cases where asset B is not available, we can create, a portfolio of assets, which will have the same risk and return characteristics as that of asset A. So in such cases, when assets have perfect substitutes, since classical finance theory assumes that, the value of stock is the expected value of future cash flows, the demand curve would be perfectly flat. Even if there is some mispricing, arbitrageurs will make sure that this mispricing is driven out of the market. However, in real world, because of friction in the market, even in case of perfect substitutes, we will expect the demand curve to be downward sloping rather than perfectly flat. So in this study, we also look at the downward sloping nature of demand curve for stocks. So it has been documented in prior literature, that supply shock is the best way to look at the changes in demand to see the downward sloping nature of demand. However, prior researchers have not able to find any supply shock in the market because supply shocks are very rare. So in such cases, researchers have used the second best option, which is demand shock. So as pointed out earlier, these studies suffer from endogeneity issues. So most common demand shock that has been used in prior study is addition of a stock to an index. However, there are mixed evidence on that. Whenever a stock is added to an index, demand for that stock goes up. So we'll expect the prices to go up. There is no change in the company. The fundamentals of the company remain same. Still, we find that prices of these stocks goes up. So prior researchers have shown that this is because of demand for those stocks is going up. However, there are studies done by Dillon and Johnson in 1991, which shows that although Standard & Poor's claim that there is no certification effect, when they add a new stock in their index, they don't certify that particular stock to be of high quality, but market interprets it as that stock to be of high quality. So when a stock is added to an index, not only the prices of that stock goes up, but the prices of bonds of that particular stock also goes up. These bonds are not tracked by index funds, so we should not see the increase in the bond prices of those stocks. Moreover, in another study done by Jain in 1987, they found that there are certain indices which are not tracked by any index fund. Still, when a stock is added to those supplementary index, prices of those stocks also goes up. In another study done by Call et al. In 2000, they use a pre-announced weight adjustment as a demand shock. So they said that there was no change in the index constituents, only their weights were changed. So for some stocks, these weights were increased, and for some other stocks, these weights were decreased. So what they found is for stocks whose weight was increased, their prices goes up. However, for those stocks whose weight was decreased, they don't see a price decrease. So we can say that prior literature is not able to convince us on the downward sloping nature of the demand curve for stocks. So in our study, we use an exogenous supply shock to study the price impact of large sale of shares. So on June 4, 2010, SEBI has mandated that all public sector units, they should have a non-promoter or public shareholding of at least 10%, and all non-PSUs should have a public shareholding of at least 10%. And they were given 3 years to comply with this regulation. So the demand curve for stocks is downward sloping. We should see a negative reaction around the supply shock. And PSUs are highly regulated and constrained firm, so we should expect to see a larger negative price reaction around the supply shock for these firms. So what we found is price reaction on the actual issue of shares is around minus 2.42%, and during the event window of 11 days, it is minus 5.44%. The day when this regulation was announced, 4th June 2010, we don't see any significant returns around that window. And as we will discuss, we rule out price pressure as an explanation for negative price reaction around these events, because we found that these turnovers, they return to their normal level within 7 trading days, but cumulative abnormal return, they don't reverse back, even after 20 days. So this is in my agenda. I'll talk about the event. I'll talk about the data that I have used, summary stat, methodology, and results, followed by conclusion. So SEBI notified on June 4, 2010 that all listed PSUs must maintain a 10% public shareholding, and all non-PSUs must maintain a 25% public shareholding. So they were given approximately 3 years to comply with this regulation. So there were different methods that promoters could use to dilute their shareholding. One was they could issue shares to the public through a prospectus, which is similar to seasoned equity offering. They can do via offer for sale. So offer for sale was a separate window provided by exchange in which promoters can directly sell their shareholdings to the public. And these OFS are active only for 1 day. So they start in the morning and then they close on the same day. And OFS was one of the most commonly method used by promoters to dilute their shareholding. Another method includes IPP, which is institutional private placement, in which promoters can privately place their shares, privately sell their shares to qualified institutional buyers. Or promoters could also directly sell their shares in the secondary market. So among these 4 methods, OFS and secondary market, these are the 2 methods which creates supply shock in the market. In case of IPP, since promoters sell their shares to qualified institutional buyers, we don't know when these institutional investors are actually selling them in the secondary market. So we include these 2 events for our event study, which creates supply shock in the market. For the other 2 methods, like rights issue and bonus issue, so in this case, promoters have to forego their entitlement. So that means only non-promoters or the public shareholders are eligible for rights and bonuses. So in case of bonus, there is a direct wealth transfer from promoters to non-promoters, because promoters are not eligible for bonus issuance or bonus shares. So we have hand-collected event data from NSE and BSE website, our event date, prices, subscription, and we also supplement our event data from Prime database. In case of data discrepancy, we manually look at company filing and company news section of moneycontrol.com website, and we supplement other data from Proves database. So this is the Indian market overview. So SEBI had announced this regulation on June 4, 2010. So latest data that was available was as of 31st March 2010. So this is the market overview as of March 2010. There were around 80 PSU firms which were listed and around 4,800 non-PSUs which were listed. So there were around 276 firms which were affected by this regulation. So out of 15 PSU firms, there were 14 PSU firms who complied with this regulation. There's one non-compliant PSU firm which had planned to wind up, so it didn't comply. And out of 261 non-PSU firms, 180 non-PSU firms comply with this regulation. So among those firms who didn't comply, most of them were running in losses, and a lot of them were suspended for trading, so they could not comply with this regulation. In terms of total market cap, the market cap of BSU is around, as of March 2010, was 17.4 thousand billion rupees, while for non-PSUs it was 44.1 thousand billion rupees. If you look at the floating market capitalization, so for PSU, since PSU firms are largely owned by the government of India, floating market cap for PSUs is very less compared to the total market cap. And as per the definition, LIC is considered to be non-promoter in India, so we also recalculate this number after excluding LIC. So if we talk about the expected supply shock, so when SEBI announced this regulation, expected supply shock in the market for PSU firm was around 214 billion rupees. For non-PSUs, were 234.76 billion of rupees. So if we compare this number, expected supply shock, with the floating market capitalization for affected firm, for PSUs it was 137%. So that means there was more stocks which were coming to the market than that were already available in the market. For non-PSU, this number was around 21%. So if we talk about our sample selection, so there were 14 PSU firms who complied with this regulation. 7 did OFS, and most of them used price priority method. And there were 6 PSU firms who were financially sick. So it was very difficult for them to sell shares in the market. So excess shareholding of these PSU firms were transferred to a separate category, Special National Investment Fund, which is managed by professional fund managers. And the plan is to sell these excess shares in the market over the period of 5 years. So among non-PSUs, 84 firms comply with OFS. Now, there were some firms for which it was very difficult to do OFS on one day. So they do 3 to 4 OFSs. So if we look at this 84 firms, they have done 98 OFSs. And most of have done using price priority method. So there were 10 firms who complied via IPP. There are 3 firms where promoters sold their shares, excess shares, directly into the secondary market on one day. There were some other firms where promoters sold their shares in a period of 1 week to 3 months. And there are certain firms who adopted a combination of IPP and OFSs, bonus and OFSs. There were 2 firms which got delisted in response to this new requirement. And there were 10 firms which got delisted because of some other reason. And there were 5 firms who were non-compliant. They tried doing OFS, but their OFSs were undersubscribed. So they were still non-compliant firms. So in sample, 76 firms were non-compliant firms. So if you look at the summary stat of compliant and non-compliant firm, so we have run a univariate test for mean and median. So we'll look at the summary stat. These compliant firms are larger firms, as it is visible from T-stat and W-stat results. Price to book average value for non-compliant firm is negative because they were running in losses, so they could not comply with this regulation. For event study methodology, we have used a market model. So after listening to the presentation by Ajay yesterday, we'll think about incorporating propensity score matching also for our study. Our estimation window is from -170 to -21. We exclude -20 to -6 days in case there is some information leakage in the market. We proxy market by CNX Nifty index, and we use Bombay et al. Methodology to calculate T-stat for abnormal returns and cumulative abnormal returns. And we also use Colarian Pioneer method to adjust T-stat for to account for cross correlation due to event date clustering, because a lot of firms comply very close to the deadline. So just to make sure that there are not any other macroeconomic event which is affecting our results, we adjust our T-stat. So these are our main results. As we can see, during the event date for non-PSU, abnormal return on that day is minus 1.88%. For PSU, the number is high, but the power of test for PSU is very low because there are only very few events. And CAR is significant till +5, it is minus 4.89%. Just to rule out that this reaction is not because of price pressure hypothesis, we test for price revision. So we run this regression where abnormal return is for a particular stock J on the event date, and this is a cumulative abnormal return starting from event date +1 till time t, where t varies from 1 to 150. So coefficient of beta equal to -1 will confirm the result that prices revert to their existing levels. So we find that we are not able to reject the null hypothesis of beta equal to -1 after 75 days. So it took 75 trading days for prices to revert to their original level. However, when we look at the excess turnover results, we find that excess turnover becomes 0 after day +7. So that means turnover becomes normal within 7 days, but prices do not revert back even after 20 days. So we rule out price pressure as an explanation for these price effects. We tried to find out the determinants of CAR. So since there were some firms which were non-compliant, to make sure that we don't have any selection issues, we run a Hackman model. So where in the first stage, we explain the compliance using firm size, because it was quite visible from the results that mostly larger firms comply with the regulation. So we explain compliance using firm size, our coefficient is significant. In the second stage, we control for industry fixed effects and inverse Mills ratio, which controls for the selection bias. In two regression, abnormal return and CAR from 0 to +1, there seems to be no selection issues. But when we look at CAR from 0 to +2, this selection bias seems to be corrected. And this RMSE, what we do is, for each stock in our event study, we find the 3 closest stocks which are in the same industry, and in terms of distance, which are very close to, in terms of price to book ratio and market cap. And we run the return of that particular stock on the return of 3 closest substitutes. Whatever residual, whatever error term that we get, we put it here, RMSE. So coefficient of RMSE here is negative, which is consistent with the hypothesis that firms which are having more closest substitute, price reaction would be lower. So as the robustness test, what we do, we also do event study on the SEBI's announcement date. We don't find significant reaction. We also looked at price reaction around company's announcement date. So firms do 2 kinds of announcement. There are only few firms, 14 firms in our sample, who announce their intention to sell shares generally 2 to 3 months in advance. So we don't find any significant reaction on the announcement date. We also looked at the announcement date where firm actually announced the event details, their event date and the number of shares that they are going to sell. We don't find any significant reaction on the announcement date. There were certain other types of events also, like bonus and IPP. We don't find any significant reaction on that day because these events, bonus and IPP, they don't create supply shock to the entire market. We also, as a robustness check, we also dropped those firms in which the event date was around of some other significant news like earning announcement or acknowledged downgrade and upgrade. Our results remain the same. And just to make sure that our results are not driven by the corporate governance, because to introduce a special resolution, one needs 75% majority. So we drop those firms where promoters reduce their holding below 75%, and our results remain the same. So what we have done in this paper is we have examined price impact created by a large scale of shares using a policy experiment, and price decrease seems to be consistent with downward sloping demand curve. And we rule out a number of alternative information-related hypotheses and also temporary price pressure effects. Thank you.
I'm discussing this paper. My name is Exes Jain. I'm from Central Michigan University. Very interesting paper, interesting sort of regulation and interesting analysis. So we all enjoyed reading the paper and learned a whole lot more about National Stock Exchange. So basically, I mean, the presenter did a very good job of presenting his research, but the broad idea was to use this natural experiment of introduction of a new regulation that requires non-public sector companies to hold at least 25% shareholding, offer that to the public. And for public sector units, they should at least offer 10% of their shares to public, which should, in theory, should increase the supply of the stocks. And the idea is if the supply of the stock goes up, that should shift the supply curve to the right. And because of the decrease in price, the quantity should go up. So the demand curve should be downward sloping. That's what they want to test. And they also want to test if the price is in fact declining, in which case the return would be negative, then when does the firm experience that negative return? Is it at the time of announcement, or is it at the time of offering of the new shares, and so forth? So that's the entire idea. And what they find is there's a significant negative excess return during 11 days surrounding the sale of the securities, and majority of the return actually occurred during the first week, and most of it comes on the issue date. They also conclude that this negative return is not information driven, so it has nothing to do with information. It's purely the increase in supply of stocks that sort of drives the return in the negative zone. All right, so I'll quickly go through my comments. Demand. The first thing is, how do you define demand? There could be demand has two aspects, right? Price, demand curve is based on price and quantity demanded, but I don't know how do you capture quantity demanded per se. So the demand, to really understand the demand curve, you need to understand both quantity demanded and price. In your paper, in this paper actually, the authors just look at the price and sort of argue that, well, since the returns are negative, that means the demand curve should be downward sloping. They also compare their research with Call et al. 2000 article, and they argue that in this paper, the revisions were all done on a single day. Like, so the supply was increased instantly at the same day, and hence it raises the possibility of some actual or something like convoluted events or something like that. But actually, I feel this setting is much better. If the supply is increasing on just one day, that's less convolution, that's less sort of a murkiness in this event, rather than the one that's analyzed in this paper. SEBI actually gave 3 years to the firms to comply with this regulation. There could a lot be going on in those 3 years. If I am the firm, I would rather plan my new offerings when the stock is most overvalued, because I have 3 years, right? And there's a greater chance that the stock will sometimes get overvalued, and I'll offload some of my stocks and take advantage of that market condition. So that's a little bit concerning, because their entire conclusion is based on the idea that, well, it's not information driven. It has nothing to do with price or valuation. But to me, it seems like, well, this 3 years is a little bit challenging to digest. That since SEBI provided 3 years to the firm to sort of meet with the regulation, if I'm the firm, I will plan it accordingly. Okay. So I need more sort of convincing case for that. Again, is it excess supply sort of argument, or is it the price impact? So when I issue new stocks and I sort of provide new stocks in the market, my sale of my stock would have price impact, and that may sort of reduce the returns in future. So to counter-argue, the authors sort of present this argument. If the price reaction document is a result of price pressure, then the negative return should reverse as soon as abnormal volume subsides. But may not be necessary, because there could be permanent price impact. So as I argued in my first slide, if the promoters chose a day where the stock is highly overpriced, obviously after that it's going to be permanent price impact. It's never going to reverse. Okay? So you need to consider that. How about demand curve shifts? You don't even consider demand curve shifts. So my argument why demand curve could shift is if I am the investor in the firm, let's say I'm a stockholder, and the firm that's trying too hard to meet the new regulation, that gives me a positive signal. Like, well, this firm is good enough. They're trying to meet the new regulation, and hence I should demand more of the stock, and we should shift the demand curve as well. So there could be a possibility of shift in the demand curve along with the shift in the supply curve. Another argument presented by the authors, PSUs are highly constrained and regulated firms and are likely to have a steeper demand curve. Again, I can counter-argue like, well, it could be possible that PSUs are much more transparent as well, right, as compared to non-PSU firms. If they are much more transparent, their supply curve could be flatter, okay? Because the price is not going to affect the quantity anymore because the price reflects all the private information. So, so that needs to be sort of accepted. The fact needs to be presented in the paper. Another argument, companies that issue bonus, another finding, in fact, companies that issue bonus or right shares to existing non-promoter shareholders do not experience any negative price reaction. So the negative price reaction or downward sloping demand curve is only existing for the firms that do new offerings like OFS, that offer new shares using OFS, not really complying using bonus or right issues. So maybe do they have flatter demand curves? Do these firms that offer bonuses or rights, do they have a flatter demand curve, in which case they don't experience any negative price reaction? Also, the conclusion is based on very small sample size. So again, this is questionable. The test, the power is pretty weak. SEBI announcement day effect, so the authors go in and do more testing, like, well, is there any effect of the announcement day itself? So SEBI came out and sort of announced that, well, here's the new regulation, and every firm needs to meet that regulation. Obviously, the test needs to depend on, day zero is very critical in this analysis. They don't have, I don't know if you have a timestamp of the announcement, but if you have the timestamp, then you can clearly categorize which is day zero, because what I found in your result is day one, you have a big sort of a positive reaction, I guess 1.71% on day one. So maybe day one is day zero in that case, right? Depending on the timing. If the announcement was after hours, so then the day one actually becomes the next day. And then the authors argue that, well, day zero there's no effect, but day one there's effect, but it quickly reverses in day 3 and 4. But then I can counter-argue, well, it could be possible that as an investor, I like that new regulation, okay? So I reacted positively and I welcomed the new regulation, but then I expected the firms to instantly sort of meet with the regulation, and the firm did not meet with the regulation, so I sort of penalized them. And then the second set of analysis they do is, then company comes out. So there's an announcement by SEBI that there's a new regulation. Then there's a company announcement that we are going to comply with this regulation using such and such method, okay? And the authors conclude that they do not find any effect. However, in their tables, what I find is there's negative excess return of 2.71%, like about 2.7% during the first 2 days following the announcement. That's a pretty big sort of a reaction. So I would suggest you test the significance of first 2 days. That should be pretty strongly significant. Overpricing explanation, I feel like you need to do more analysis over there. What they do is they argue that, well, if in fact the firm are choosing the days when they are overpriced, then this compliance, what they do is they compare the compliant firm with the non-compliant firm. They say, well, the compliant firm should be overpriced, and hence they are meeting with the regulation. And non-compliant firm, they are never getting overpriced, and hence they never meet with the regulation. But then, instead of doing that, why don't you analyze timing of this new supply? So, and look at when the firm actually comes and sell these new stock. At that time, is the firm overpriced or not? That's a good test, rather than just comparing the compliant versus non-compliant firms. Just look at the compliant firms and see the timing of their new supply. Timing when they offer the new shares to the market. At that time, if they are overpriced, then it's overpricing argument. If it's not, then your story may be correct. price movement around deadline. I'm losing my trail of thought here, but I only have 1 minute anyway. So I guess what I wanted to see more, like you analyze all these events, okay? How about analyzing the last event where they have a deadline, all right? They have a deadline, they have to meet with the regulation. What happens right around that deadline? Would be interesting to know, because as an investor, I'm worried if my firm has not met the regulation yet and there's no information. Those firms should be penalized even badly, I guess. And so looking around that deadline may give you even more interesting results. Last thing, I mean, obviously you can do more on calculating AR. You use simple market model. How about factor models, right? More robust, like more control for the risk, and so forth. I think that overall interesting paper. I would recommend people to read it. Solid data. Data is very extensive and good analysis. Obviously, it has potential for deeper investigation where you can do more robust analysis and so forth. Thank you.
Thank you very much, Pawan. Do you want to respond quickly?
Yeah, thanks, Pawan, for your valuable comments and feedback. So, regarding your comment on the effect of company announcement date, what we have seen at most of the firms, they announce their event details 2 days in advance. So if you look at the effect on +2 day, that is not because of the company's announcement date, that is because of the event date. So that is one thing. And regarding bonus and IPP, yes, there are only small firms in the sample. So I mean, we don't see any solution to it as of now. Regarding permanent price impact, I mean, we don't see a permanent price impact because what we find is after 75 trading days, prices revert to their original level. So what we find is these price effects are actually temporary because there is no new information about the firm that is coming. And definitely, this is a good suggestion. We will look at the firms which have complied around the deadline, because what we have seen is most of the firms comply around the deadline. So it is less likely that they must have timed their issuance. So we'll definitely do an event study on those firms. And regarding your inputs on demand curve and supply curve, we will definitely think about it.
Sorry, I was just reading something. Yeah, Rick, why don't you go ahead?
If I understood this price reversal test, what you're doing is you're accumulating abnormal returns, and then you're saying when it is not significantly different from zero. And if that's the case, then that could simply arise from your confidence intervals becoming larger and larger as you start accumulating more and more days. And at some point, you will say that everything is equal to zero. And then you'll say at this point, prices have reverted back and your cumulative abnormal returns are back to zero. But I don't think that is a valid test for showing a price reversal. So what you have to do is, let's say your price drops over the first 7 days, then you have to show me that after 7 days you start accumulating and then you do see a significant positive return which matches up with the initial negative return that you have seen. Okay. I might have gotten your test wrong, but from what I understood, that was it.
If it helps, you talked about how when SEBI announced this in 2010, there was absolutely no price effect. Have I got it right? Now, it could well be that since the market had been told in 2007, that was when the SCR rules had been amended first, and nothing happened after that. So people would have, once again assumed that this is just another announcement that we have to reach the desired 75% promoter holding. And since the first time around it was forced on the market did not comply, and SEBI did nothing about it. So it could again be another, false call. So the market would not react on the day that, in 2010, because there was already an occasion in the past when people did not comply and no action was taken. So, it could answer that question as to why there was no effect on the announcement date of SEBI in 2010. because this had been announced by the ministry, I think, in 2007 itself. So, you know, it could be one of the reasons, because the market doesn't believe that anything's going to happen. So, you know, that was one point. The second point is, you know, I'm really happy that you've studied this, because I was not even aware that, you know, people were looking at this kind of data. And I was at the receiving end at SEBI when, you know, in a particular few PSU stocks, ONGC being one very, very clear example, where the announcement from the company saying that we are looking at doing an OFS led to a significant decrease in price, leading the government to actually not go ahead with the OFS. So, you know, we've spent enough man-hours understanding, you know, who's selling what in the market. And, you know, therefore, it'll be very useful if you could actually send this to the Ministry of Finance to convince them that price effect due to the announcement of increase of supply of shares has to happen. You know, it is but obvious that when, you know, the government holds 99.9% as in MMTC and Hindustan Copper, and if you are selling, you know, 5% of your holding, you're multiplying the floating stock by a significant multiple, the price has to go down. So, you know, I'm really happy that, you know, you've got this finding, if I've understood it correctly, that there is no other information but the supply which is increased, which is leading to the price fall. So that's a very useful, you know, finding. But I also did not understand the price reversal concept, because why are we expecting that prices will reverse after 75 days? I mean, the market may have gone up, and because of which, you know, stocks have all round gone up. So maybe I completely lost the point on, you know, price reversal and its significance.
Yeah, I think the null hypothesis should be that there should be no reversal, right? Because this is a supply which is permanent. So you should see a price drop which will stay. So if it reverts, actually, it gives you some sort of an information or transitory sort of nature, which makes it hard to kind of understand.
But in other contexts, this is the slow-moving capital argument. So basically, when there is a supply increase, temporarily the price drops, but then there is more capital that comes in over time, which then, so the demand increases, but not immediately. This is true for, this is seen in other contexts as well.
Very good. Yeah.
Sorry, just a quick question. So does this dilution takes place in one go, like when the firm is going from 10% to 25%, that's a big change in capital structure. So do they float their shares in one single go, or do they do it in tranches, like in 2 goes or 3 goes? Because it might be a good idea to study these cases separately, maybe firms that are going in one single go and firms that are going in 2 or 3 different tranches, and then look at the effect, because that might be a way of price manipulation, or maybe not in PSUs, but in non-PSUs it might be the case.
All right. Any other question?
Just to chance an answer to that, I think what the merchant bankers who help the companies do the IPP or OFS, whatever it may be, they'll gauge the kind of ability of the market to absorb so much of capital. So often we've seen that, you know, in private non-PSU companies, you're offloading, you know, 2 or 3% at a point of time. So, but it really depends on the market cap of the company at the time it starts.
Sometimes the participants wouldn't even know that an activity like this is going if it's just 2 or 3% going in every couple of months.
Yeah.
Yeah, I'm Kavalpreet from FRG. I just wanted to ask you one question about the PSUs specifically. So as I understand, when you're having an offers for sale for the PSU, the decision is taken over a 6-month period, approximately. So there are various stages in it. The cabinet committee decides on this investment, and then the issue offer price, the date is decided, on a particular date, the government says that the issue will be done and the price will be so and so. So the event window of a 180-day period has a lot of different events coming in as well. So that might affect the price. So if the government announces 6 months before that it's going to disinvest, the price reaction might not happen. It might happen only after 3 months when they actually say that the offer price is going to be whatever they announce, right? So it might be more effective to break that window into different events and then see reactions around different events. I could point you to a particular paper. This is Sehgal and Gupta in 2014, where they've done a more detailed research on this issue.
Yeah, Pradeep?
Can I just ask, it reflects my ignorance probably of the exact provision, but how is this different from the very large number of cases where big privatizations take place, where governments sell their equity in lots, or where large promoters who hold shares, they do an issue where they sell their own shares. How is this different from there? So there must be a lot of cases in which this kind of thing has happened in the past. So how would you manage to sell your contribution as something which is kind of different?
Okay. So it has been shown in prior literature.
Yeah, but I mean, mandating or not mandating, the question is, if you are, how does the supply shock differ, whether it is mandated or not mandated? I mean, when the company says, when the government says, okay, I'm going to sell 10% of my shares. Now, there are so many privatization sales which have been done on a staggered basis in Europe in particular, where the share of the government goes down from 99% to sometimes 0, but in a lot of small stages. So all of those are sales of the same nature, as far as I understand. So you have the same kind of evidence there. All of those sales will take place in a similar kind of environment. There are a lot of event studies which have taken place in that context. How are those event studies different from what you're doing?
So like, in prior literature, like some researchers have mentioned that, the price reaction in such cases depends upon the identity of the seller. So that means it brings some new information about the seller. But here what they're arguing is that there is no information about the company that is coming into the market. It is just an exogenous supply shock.
Well, one comment on that, like because it's mandated, so what authors argue is like they cannot really, and I don't agree with that argument, but they said they cannot really sell it when it's overpriced, versus in case of IPO, lockout period, and so forth, when the promoters try to sell their additional stake, they could time it. They could time it according to their valuation of the firm. If they think firm is overvalued.
But I thought you said they could do it anytime in 3 years.
So
they have the option to choose the
right.
time.
Right.
And that option to be able to choose the time in the next 3 years has to be valuable.
That was my comment. Like, well, if you give that long of window, they can time accordingly. So that's where the timing effect. So one way of testing that would be, as I suggested, looking at the compliant firms and then see if they're at the time when they're selling, are they overpriced? If they are overpriced, if they are not overpriced, then that takes care of your comment, because maybe they are close to the deadline and they say, well, we have to meet the deadline right now, and so we have to sell it right now. In which case, it may not be like in your.
So one way to, maybe one control you can have is some of these firms might have had insider sales in other times, right? Maybe you could use, because if there is some information by selling, and in this case there is no information, they are just selling because of regulation. So you should be able to sort of use them as controls for the same firm.
Or look at the guys who sell very close to the date by which they're supposed to sell, but they haven't done it yet.
Correct. So like a deadline type of thing, yeah. I think, do you want to address that answer before we move on to the next paper?
Excuse me. Sorry. Actually, just to add on Professor Yadav's comment, there is an entire literature on state-owned enterprises by Bill Megginson. And then there is a specific article from Deventher and Warther in AER 2001, which looks at state-owned enterprises abroad, which is a kind of a replica of PSUs in India. And they say that irrespective of whether it's an initial offering or a subsequent offering, state-owned enterprises do lose value over time gradually. So if you're saying that there is a negative return after listing because of this external shock, technically there is an established literature which says that even if there is no shock, the SOEs do lose value gradually over time after listing. So you might have to find a little bit different story or something like to pitch that. What's the other driving force which is decreasing or their value or the return over time?
Okay, Ankit, do you want to quickly respond before we move to the next paper? We are a little bit behind.
Sure. So regarding the question on price reversal, so in our regression, we don't test for the significance of coefficient. I mean, what we test is whether the coefficient of AR, beta is equal to -1 or not. When coefficient of beta is equal to -1, that would mean that CAR is just the opposite of abnormal return. So which would mean that prices reverse to their existing level. And regarding, there was a question about, firm doing single OFSS and multiple OFSS. So we have seen that there were some firms who were not able to sell their shares in one go. So they had to do it 3 or 4 or 5 times. So, we have dropped those firms from the analysis, when results remain the same. And regarding your comment on the decision for PSU disinvestment, so there might be, some announcement by the government that government is planning for disinvestment, but we have looked specifically for, this channel where, the government of India had decided that promoters or the government of India should do this via OFSS, and there was no announcement. I mean, we have manually tracked the announcement for all of the firms, for PSUs as well as non-PSUs. So for some firms, there was some data that, there is some announcement that, government has intention or firm has intention to comply with this regulation. So, but we don't find the reaction on that date. So what we are arguing is there is no new information which is coming once this announcement comes to the market.
Also, there will be a slight difference, one more point, vis-a-vis privatization and this OFS trickle which might have gone out. If there is a big new promoter coming in, maybe the effects will be a lot different from the OFS model, where it's a dispersed holding and just offloading. And totally outside this, I thought another study where there's a lot of price impact per se on decision making is when scripts go in and out of derivatives. I mean, there's totally different. I thought that's worth studying, maybe some other.
Actually, his co-author is doing a paper on that. So I'm afraid this is we should take everything else offline. We have our next paper, which should be a little bit refreshing of looking at outside India for a change.